Welcome back to Build Wealth Now News. I'm your host, Billy Bob, and today we're unpacking one of the most surprising pullbacks we've seen across the software sector this quarter. A handful of fundamentally rock-solid companies have been hit with a wave of selling, not because their businesses are deteriorating, but because the market is reacting to the sudden buzz around Anthropic's new Claude Cowork plugin being offered for free. Investors are treating this like a category-wide disruption event, and in the process, they're dragging down companies that remain absolute powerhouses. Just look at the trade desk. This is a company with deep partnerships, a dominant position in programmatic advertising, and a long runway as ad dollars shift toward connected TV or CTV. Yet even the trade desk has been caught in the downdraft, despite nothing changing about its competitive moat or its long-term growth story. And it's not alone. Monday.com, with its expanding enterprise footprint and sticky workflow ecosystem, has pulled back. Toast, which owns the restaurant operating stack from payments to hardware, has slipped even though its fundamentals remain strong. Even Duolingo, one of the most engaging consumer apps on the planet, has seen its stock dip despite record user growth and subscription momentum. These are not fragile businesses. These are companies with durable revenue engines, strong balance sheets, and competitive advantages that don't evaporate just because a new AI plugin hits the market. Sarah, what's your take on this?
Thanks, Billy. What we're seeing right now is a classic case of the market reacting first and thinking later. The release of Claude Cowork as a free plugin has triggered a wave of fear that AI will instantly compress margins across the entire software landscape. But when you look under the hood, the fundamentals tell a very different story. Let's start with the trade desk. This is a company operating in one of the most complex, data-rich environments in tech, programmatic advertising. Their moat isn't just software, it's relationships with agencies, integrations with publishers, and a decade of infrastructure built around identity, measurement, and connected TV. A free AI plugin doesn't suddenly replicate that ecosystem. The same dynamic applies to names like Monday.com, Toast, and Duolingo. These companies aren't selling simple interfaces that AI can replace overnight. They're selling networks, workflows, data, and in many cases, entire operating systems for their customers. Monday.com is embedded deep inside enterprise teams. Toast is literally running the front and back of house for restaurants. Duolingo has one of the strongest engagement loops in consumer tech. So the pullback we're seeing isn't about weakening fundamentals. It's about sentiment. Investors are pricing in a hypothetical future where AI instantly commoditizes everything, even though the real world moves much slower and moats built on distribution, data, and switching costs don't evaporate because of a new tool. In fact, if you zoom out, many of these companies stand to benefit from AI because they can integrate it into their existing platforms, not compete against it. So the key question for investors right now isn't will AI disrupt software? It's which companies have the scale, data, and customer relationships to turn AI into a tailwind rather than a threat. And that's where the real opportunity lies.
Let's drill deep into the trade desk, ticker TTD. If we get this right, this could be a multi-bagger for our viewers. Stocks down 70% this year. Sarah, your analysis shows revenue growing nearly 20%. How does that even happen?
Billy, it's the classic fundamentals versus fear story. Let me break it down simply. TTD runs a software platform that helps ad agencies buy digital ads across streaming TV, websites, and apps. They charge a 10 to 15% fee on every dollar advertisers spend. Last quarter, revenue grew 18% year over year, while operating margins expanded from 15% to 22%. TTD delivered 18% to 25% revenue growth every single quarter in 2025. Textbook growth company behavior.
So why the bloodbath in the stock?
Because investors aren't looking at what TTD is doing. They're pricing in what Amazon and Google might do. TTD's a pure play platform. They don't own Netflix or Disney inventory. Amazon's DSP does, and they're bundling it with Prime Video at aggressive prices. That's the fear. Ecosystem players can subsidize their ad tech while TTD can't. Way back on the February 12th, 2025, Q4 earnings. Stock dropped 20% that day despite 22% revenue growth. The miss wasn't on sales. It was on guidance. Management signaled Amazon's DSP was winning premium connected TV or CTV inventory deals with Netflix and Disney while undercutting on price. That sparked the re-rating.
And it never recovered?
Never. Even when they beat estimates in Q3 2025, shares fell another 8%. That tells you this isn't about quarterly surprises anymore. It's a structural concern. Pure play ad tech platforms like TTD don't own media inventory. Amazon and Google do. They can subsidize their DSP businesses. TTD can't.
What's actually working for them right now?
3 things. First, retail media partnerships. Walmart, Kroger are gaining traction. Second, their OpenPath initiative is showing results. Partners like Freestar reported 27% revenue lifts by cutting out middlemen. Third, their AI platform Kokai launched Audience Unlimited late last year to reduce third-party data costs. Solid execution, but again, overshadowed by competitive fears.
Tell us more about the business execution.
The business has performed extremely well by Phase 3 growth metrics. 6 out of 7 key health indicators are green. Revenue growth, margin expansion, R&D investment at 19% of revenue, cash flow up 28%, 0 debt, and that 95% plus retention. Only one yellow flag. Net revenue retention is just barely above 100% instead of the ideal 110% plus. But operationally, this isn't a broken business.
In your Moat analysis, what are their defenses?
2 strong ones. First, neutrality. Agencies trust TTD because they're not competing for ad dollars like Google or Amazon. That's why client retention stays above 95% for 11 straight years. Second, their AI platform Kokai, trained on $100 billion in historical ad data, is driving real results. Existing clients increased spend 12% last year, and 68% now use 3 or more ad channels through TTD versus 42% 2 years ago.
TTD is trading at 3 times sales when it averaged 12 times historically.
The market's pricing in a growth cliff, expecting revenue growth to collapse below 10% within 2 years because of Amazon. But here's the disconnect. Q3 gross spend, the leading indicator, still grew 18%. CTV ad buying through TTD jumped 35%. Retail media partnerships with Walmart and Kroger are scaling. The fundamentals haven't broken yet.
So what's the risk for someone considering this at $27?
The low for 2025 was $35.65 on December 15th. Since then, it had continued trending lower. That's just pennies above its 52-week low of $26.01 on February 3rd, 2026. For context, it traded above $125 a year ago. It became the worst performer in the entire S&P 500 in 2025, down 68% while the index gained nearly 18%. 2 paths forward. Bull case, CTV and retail media adoption continues. OpenPath gains traction with publishers, and TTD proves open web advertising can coexist with walled gardens. At 3 times sales with 20% growth, that's deeply discounted. Bear case, Amazon locks up premium streaming inventory exclusively, agencies shift budgets permanently, and growth decelerates faster than expected. This isn't a momentum trade. It's a structural bet on whether neutral ad tech survives.
Any sign of capitulation or support?
Short interest sits at 9.6% to 11.2% of the float, elevated but not extreme. There is a potential for a short squeeze if the stock rises. Analysts are split. 17 strong buys, 2 buys, 17 holds, and 2 sells, and 1 strong sell. Average price target at about $81 for 2026, which implies more than 100% upside. Those numbers are from Zacks Research. Confidence is medium at best. The next real test is February 25th, Q4 earnings and 2026 guidance.
Final take for our viewers watching right now.
If you believe open web advertising can survive against walled gardens, TTD at $27 offers exposure to CTV and retail media growth at a distressed valuation. If you believe Amazon and Google will commoditize the entire stack, this could go lower. This isn't a momentum trade. It's a structural bet. Know which side you're on before you buy.
Sarah, thank you. Clear, factual, no hype. Folks, hit subscribe, ring the bell, and tell us in the comments. Are you buying the dip or waiting on the sidelines? Thank you to all our viewers for staying with us. See you all in our next market summary. Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk, and you should do your own research before committing any stock to your own portfolio. This video is done for educational purpose only.